If you ask a seasoned investor what is in store for markets, it depends is an answer you'll hear often. It's an honest reflection of how realities are not as simple as black or white. And our next guest says they're maintaining a glass half full outlook in 2026. For more, we're going to bring in Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel. And you're in studio with us. Thanks so much for coming in.
Oh, it's a pleasure to be here. Happy New Year.
Happy New Year. Yeah, the first trading day of 2026, second day of the year. Why do you have the kind of half glass full approach heading into the year?
Well, there's several reasons that we feel that fairly constructive on the backdrop for 2026. One of the key things is the earnings story remains relatively robust. And as we saw in 2025, earnings, and both in Canada and the US, if you will, were the key drivers of equity market returns in both markets. So that is, in particular, S&P 500 and the S&P TSX.
We saw, a 3-year bull market so far, roughly. Some could argue that. Usually, historically, that goes on for 5 years. Is that the pattern you're seeing continue into 2026?
So bull markets on average, right, and we've had, extremes on either side, right, that tend to create that average of 5 years. We're going into, the fourth year of this bull market. That doesn't mean it's going to end. Bull markets don't die of old age, if you will. Fundamentally, as I said, beyond the earnings, we're seeing a very supportive economic backdrop, right? And so from our standpoint, fears of a recession or something more systematic is not in our base case scenario.
Okay, so I know you're feeling pretty optimistic about the year ahead, obviously.
Constructive, I would say.
Constructive, okay, yeah. Constructive. But there is still some volatility maybe expected this year. With that in mind, how are you advising investors to kind of head into the year?
Yeah, and look, if we look at chart number 1 or graph number 1 that, I recently sent out as part of my note to clients, we've seen a fairly diversified and constructive backdrop globally. So while the S&P 500 has put up a 2025 return of about 17%, Canada, the TSX, quietly has put up a 30% rate of return, and the story is even more constructive when you look outside of the US, right? And so we're seeing very strong underpinnings, not just in Canada and the US, both from an economic growth perspective, from a monetary support or policy stance point of view, as well as fiscal spending. So again, when we look outside of equity markets in North America, we're seeing some consistencies in terms of the underpinnings of equity markets globally.
That's what's so interesting. It sounds as though, if we're looking at maybe potential winners for this year, it's international markets or markets overseas and maybe not so much the U.S.
Well, look, the U.S. market is deep. And so that depth allows for investors to actually find, unique opportunities. So what you are seeing, at least for the U.S. market going out to 2026, is a broadening out. That's our thesis. So we think that a continuation of, the broadening out of performance from the Mag 7 or Mag 10, if you will continue. So there are opportunities in the U.S. It's just outside of the Mag 7 and Mag 10, in more other industries that are, outside of the infotech or the semis, if you will.
Okay, so by deep market, you mean there's other things and other sectors and stocks you can invest in the U.S.,
that's
a lot of
sure.
opportunity.
Exactly, and that's within the S&P 500, so you could stay large cap oriented and still pick up some very high quality growth ideas that are outside of, let's say, that narrow aspect of the market, which has driven a lot of the growth that we saw in 2024 and a lot of that growth to the better part of 2025.
And that growth we saw in 2025, despite geopolitical factors around the world that we're seeing, right? Heading into 2026, is there anything you're watching for geopolitically that you think could maybe shake things up? Not
Sure.
to dampen your optimistic mindsets.
Yeah, so look, there are a lot of risks. There were a lot of risks in 2025, as we saw, right? Half glass empty, if you would, during April, right? And that quickly flipped to half full as we moved into the back half of the year, right? And so when we look at 2026, there are definitely some levels of risk that we're really focused on. The midterm elections, November, USMCA, we have to hit some level of a deadline or some sort of agreement in July. So that's going to be
it's a big one.
An ongoing challenge for Canadian investors, if you will. We're still seeing sticky inflation. So inflation kind of sitting at the upper end of Bank of Canada's target range, as well as for the Fed. So we probably won't get much more easing on the monetary point of view. But what we are going to see is the benefits of those cuts from 2025 work their way into the real economy in 2026, right? So there are risks for sure if inflation heats up even further, if the tariff rhetoric amps up. These are all things that continue to kind of weigh on our outlook, and that will force us to change if it materializes in a meaningful way. But as it sits today, just the earnings trajectory, valuations, again, don't seem too stretched, and I'm talking specifically for the TSX and the S&P 500. Close to 5-year averages, slightly at a slight premium, but nothing extreme like we saw during the dot-com crisis, right? So again, I think still fairly constructive. There are risks, so investors should be well diversified, not only within markets and across sectors, but also globally and across asset classes. Speaking globally then, are there any sectors that kind of excite you that you're watching for across the globe this year? Yeah, look, I think infotech, I think the AI trade is, there's still a lot more, there's still more running room for that trade to materialize. We saw the first order effects probably in 2025, to some degree in 2024. Now we'll start seeing the second order effects. We'll start seeing productivity benefits. We'll start seeing other industries realize the benefits of implementing AI across their operations, right? So a lot more downstream benefits. So, if we look at infotech in Canada and the US, double-digit earnings growth. Again, a different story, different mix in terms of the drivers of what that is. But namely in the US, it is an AI theme that is continuing to support that favorable outlook. So outside of that, I think pro-cyclical, we still like financials. Industrials haven't performed as well as some would probably hope. But again, the favorable backdrop, especially with the accelerated bonus depreciation, companies will probably opt for that in the U.S. with the one big beautiful bill, right? And so that was a key tenet of that bill that's going to enable companies to accelerate their depreciation in year one and realize the present value of essentially those benefits over several years in that same year, right? And so that allows them to free up capital and really put it to work, right? So again, I think there are reasons to be bullish on more cyclical aspects of the broader U.S. market as well as Canada. Okay, we'll have to wait and see what exactly happens. Thanks so much for coming in. It's my pleasure. Appreciate you making the time. Thank you so much. That is Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel, joining us in studio.